Hello, and welcome to the latest Expert Series webinar. Today's presentation is Don't Be So Sensitive, Multiple Solutions to Mitigate Interest Rate Risk. This is a complimentary ETF.com webinar courtesy of Market Vectors. I'm Olly Ludwig, the managing editor of ETF.com, the leading authority on news and data about ETFs and the company behind Inside ETFs, the world's biggest ETF conference. Joining me today are Fran Rodilosso of Market Vectors and Pratik Mehrotra of Endowment Wealth Management. Fran is Senior Investment Officer and a Portfolio Manager of Market Vectors Fixed Income ETFs. He is responsible for portfolio strategy and credit market analysis. Pratik is the Chief Investment Strategist with Endowment Wealth Management, based in Appleton, Wisconsin, and runs about half of its business using ETFs. Pratik manages relationships with high net worth clients, institutional investors, and traditional and alternative money managers, including hedge funds, private equity, and managers of real assets. A bit of housekeeping before we get started today. I may chime in with a few questions along the way, but I'd like everyone to know that there will be a Q&A session at the end of the presentation that I'll moderate. And all of you can ask questions at any time during this webinar in the window at the lower right of your screens. Also bear in mind that the presentation will be available to all of you 24 to 48 hours following today's webinar. Now, it's no secret that bond yields in fits and starts began to move higher once the Federal Reserve first signaled that it would begin pulling back on quantitative easing in May of last year. In May, after former Fed Chairman Ben Bernanke commented on the need to taper, that became part of the financial markets lexicon, and yields started marching higher. Yields on 10-year benchmark Treasury notes almost doubled by the end of the year and actually hit 3% at the very end of the year. Now, investors who held onto their positions did indeed suffer capital losses, giving rise to concerns that as the 30-year rally in Treasuries reverses, investors are likely to get a bit beaten up. Last year's flows in the ETF space in fixed income strategies tell this tale in a different way. Overall, net inflows into bond-related strategies were rather light at about $9 billion. But looking more closely, the lion's share of those inflows were on the short end of the yield curve, which picked up about $23 billion in new assets, according to data we compile here at ETF.com. So far in the first quarter of 2014, short-dated bond ETFs continue to be popular among investors who appear increasingly convinced that even if rates are taking their time going up, rise they will over time. So today, we'll look at ways for investors to effectively address the challenges associated with the general increase in interest rates, including shortening duration, hedging duration risk, or owning a fixed income instrument that has changing yields built into it. Specifically, we'll look at three Market Vectors ETFs today, one with a short bond duration, that is the Market Vectors Short High Yield Municipal Index ETF. It is trading under the symbol SHYD and has about $25 million in assets. Additionally, we will look at the Market Vectors Treasury Hedge High Yield Bond ETF that trades under the symbol THHY. It has a little bit more than $10 million in assets under management. And finally, we will look at the Market Vectors Investment Grade Floating Rate ETF. It trades under the symbol FLTR. It has nearly $100 million in assets under management. All these instruments provide investors with ways to meet the challenge of rising rates. There is scarcely a more topical subject in the world of money management these days. I'm going to hand it off to Fran Rodilosso. Initially, he's going to talk about some disclosures from Market Vectors' perspective, and then he will hand it off to Pratik Mehrotra. So without further ado, here's Fran Rodilosso of Market Vectors. Fran, take it away.
Thank you very much, Olly, and thank you for joining us, everyone who is on the call, and thank you, Pratik, for joining us as well. It's my distinct pleasure to start off by bringing your attention to various disclosures on page 2. Please take note of the general disclosures for today's presentation about risks of investing and investing in investment products. The following page 3, is more information on general disclosures and then disclosures on risks associated specifically with investing in municipal bonds. Slide 4 highlights the risks associated with investing specifically in high-yield bonds. And finally, slide 5 highlights the risk associated with investing in investment-grade floating rate notes. Thank you very much for your patience on that, and I will now pass it to Pratik.
Thank you, Fran and Olly. Good morning or good afternoon to everyone who's on the call. I'm happy to be part of this session today, and I want to take a few minutes here just very briefly introducing our two businesses. I'm not going to bore you with our disclosure at the bottom. I think you've seen too many slides on the disclosure already, but we were asked to put a disclosure related to liquid alternative investments. So it's kind of in fine print, and you can read it at your leisure later. Our primary business is dubbed Endowment Wealth Management. And just to give you a little bit of background there, we formed this multi-family office last year after we merged with a single-family office that was in existence since 1996. So we've been around for a while. The RIA has been around for a while. And our goal here primarily is to serve high net worth families. And as you can see or guess from our name, Endowment Wealth Management, the use of the word endowment kind of personifies our investment philosophy, or what we call the endowment investment philosophy. And it's really nothing more than saying who have been the most successful institutional investors and how have they achieved their success, and let's learn from the best and the brightest and see if we can bring that down to our high net worth families that we serve. So that was the underlying premise there. The team that we have here has many years and many decades of experience, professional experience, and we've managed several $100 million in assets in our past and won numerous awards. And the unique nature of our business is where we've invited some of our multi-family office families to take ownership in the business. So we are owned by some of our families. Now, the way we built our portfolios is we've taken a best-of-breed approach, call it the active-passive approach, where when you're not sure if you're in a secular bull or bear market, you kind of take a middle-of-the-road approach. And what we've done is, in terms of just framing this investment puzzle, we've broken out our asset buckets into 3 large buckets, what we call the global equity bucket, the global income bucket, and then the risk managed bucket. And you also can refer to that as the liquid alternatives bucket. And these large circles really represent the core or the passive piece of these portfolios, where the focus is really low cost beta exposure, and then we are supplementing that with active satellites. So you could say we are vanguarding at the core, and then we are going with active money managers, outsourcing it on the satellite of each of these buckets. And since we are in Wisconsin, where our religion really is football, I wanna frame this as a football analogy, where our offense is our equity growth bucket, our defense is our income bucket, and then you could think of the risk managed as our special teams. And so what we've done is we've taken a Lego building block approach, or really a modular approach, where once we have these 7 building blocks, advisors that want to put their own risk allocated portfolios together can then blend certain percentages of these 3 buckets and create their own endowment portfolio. And our second leg of the business, which was on the earlier slide, is dubbed ETF Model Solutions. And the same portfolios that we're using for our high net worth families, we have opened it up under that particular business as a third-party managed ETF model manager or third-party ETF strategist manager to advisors who might want to say, this is an interesting approach to build an endowment allocation. and it's very low cost. Our fees there are much significantly lower. And obviously the goal, why you want to add this third dimension is, if you're worried that, stocks are getting toppy, if you're worried that fixed income is kind of, it's in a bull, has been in a bull market that's now going to turn into a long-term secular bear market, and your two main asset classes are kind of, fairly valued to overvalued, then you need to do something else with your portfolio, and that's what we call the third dimension. And I can keep talking, but I would pass it on to Fran. Hopefully that frames, some of the discussion we'll have today. And, and I'll talk a little bit more about how we're using ETFs and fixed income ETFs within our three fixed income models, namely the short duration fixed income, the global fixed income, and the multi-asset income. And then we can get into a little bit more details, and I'm more than happy to provide color on the call today and later for whoever is interested in learning more. So it's back to Fran, and then see you a little bit later in the Q&A.
Great, Pratik. Thank you very much. Seeing as you're all the way in Wisconsin, we know you're not pursuing any high-frequency strategies on the tactical side. For those of you who've read the recent book, you'd be too far away from New Jersey. So we're glad to see that. I will just give a few minutes of background on Market Vectors and Van Eck, our parent company. Van Eck is a 60-year-old firm who, until approximately 2006, was involved mainly in traditional mutual fund products. Traditional in that they're mutual fund products, not traditional in that Van Eck has had a long standing involvement in areas such as commodities and emerging markets. So in that sense, very non-traditional. And even in its ETF offerings, that's a theme that has stuck with Van Eck. We try to be innovative. Our main form of innovation is providing access to markets where investors have not had access, or where they have not had cost-effective or diversified access to certain markets. So that is our MO, if you will, is to provide exposure or improving the type of exposures investors may get to a variety of markets in the U.S. and beyond. I doubt many of you need to see this chart, and sometimes it's painful to look at, but we just wanted to highlight again, as Pratik just mentioned, are we on the cusp of a sectoral bear market in treasuries or in interest rates? If you think about some other economies that have had very prolonged periods of low interest rates, you would say maybe that does not have to be the case. But we like to remind ourselves where the risks are in the world, and in our markets in particular. And after a very strong 30-year bull market, and considering the policies that our central bank have pursued over the last several years, and considering that they are now seeking an exit to those policies, page 9 here is just a strong reminder of maybe less than symmetric risks in terms of higher rates versus lower. That being said, rates have adjusted already in some parts of the yield curve, as we saw in 2013, and as Olly alluded to in his introduction, the mere talk of tapering asset purchases forced a shift upward in yields out the yield curve, where the Fed was buying assets. The interesting thing to note, and the interesting reminder for everyone, is the asset purchases were one part of Fed monetary policy, and the other is the near zero interest rate policy. And both are still in place, but the Fed is, of course, tapering, and we've seen an adjustment because of that. What we think is interesting to think about, of course, is when the Fed funds rate will be adjusted, when the short end of the curve will start rising. How will that impact the long end of the curve? You may see and we think there's a very good chance you'll see sometime in the next 2 years the entire curve shift higher. You may see the very front end move higher in yield relative to where it is now than the long end. As an investor, you would still possibly do worse on being out the long end of the curve, even if its yield moves less, because of the impact of duration, which is something we will talk about later. But Jen, just laying out some perspectives here. You've got plenty of things that could happen. We could all be caught by surprise by a sudden weakening in the global economy beyond people's fears, where we see rates come in. But again, we think the risks are skewed otherwise, and we think the Fed is beginning a process that's going to leave a lot of open questions for the market. As we discuss our products in today's presentation, I wanted to also talk about components of return in a lot of the fixed income market. When you're talking about return on treasuries, you're talking about interest rates purely. When you're talking about returns on a lot of other products, non-government bonds, including corporate bonds, you are talking about both the underlying interest rate and a credit spread. A yield on a corporate bond or a municipal bond is different from the yield on a treasury bond, and particularly in the municipal market these days, as we'll talk about. The idea of credit risk and a spread for that risk has become even more significant. The point of the slide we're showing now is really twofold. One, when interest rates are rising, the spread, the risk premium that a corporation might have to pay relative to treasuries does not necessarily rise as well. Treasuries may rise and credit spreads may come in. We saw that happen, if you look at the very right side of this chart, over the course of the last year, in fact, where treasury yields rose, or interest rates rose, and the credit spread, or the risk premium for corporate credit, actually came in. There are, the arrows on this chart show other periods where that happened, the late 90s, between 2003 and 2006. There are other periods, however, I should definitely note, particularly as it relates to some of the products we're going to talk about today, where treasury rates may fall and credit spreads may move wider. And that.
Fran, can I chime in really quick on the question of spreads? I'm sorry to interrupt you. It seems fair that the corporate balance sheets in the U.S. anyway are really pretty healthy and have been generally healthy in the past decade or so. Does this affect the spread outlook in your judgment? The fact that that corporate credit is, relatively speaking, pretty solid, and that treasuries are going to be the driver of how spreads play out here in the coming in the coming months and years? I know I'm kind of being oversimplistic, but really it seems that the credit quality in corporate America is relatively high in historical perspective right now, right?
It is. Corporate balance sheets are generally speaking at a fairly low level of leverage from a historic point of view. Cash levels are high. It's also sort of a self-fulfilling situation where the ability to refinance debt at cheaper levels, at lower yields, as the Fed has helped create over the last several years, has improved the credit profile of the very borrowers who have access to the market. Short answer, yes, I agree. We have been, as a firm, stating a higher level of comfort, basically, with credit risk than interest rate risk over the last 18 months or so, and believe that is still the case. It does not mean that every corporate bond is appropriately priced. It does not mean that some parts of the corporate market might not be relatively expensive, but the bigger fear, bigger risk to us is more on the interest rate side at this point in time than on the credit side. So if that was your point, I agree, Pratik. As Olly mentioned, we're going to talk about three products from the market vector side today. Three ways a fixed income investor can remain invested but reduce exposure to rising interest rates. So all three strategies involve basically reducing your duration, which is the way your portfolio might react in terms of return to rising rates. but one does so directly by shortening the duration of the bonds you hold. A second strategy reduces duration by shorting treasuries. It's reducing interest rate duration, so trying to neutralize the interest rate exposure. And the third one goes at duration by using floating rates. And I will address all three of those more specifically right now. Approach number one, as I said, using bonds with shorter duration, basically shorter maturity bonds, to make a more simple proxy for duration. This is shortening duration by moving down the yield curve. We have a product that does this in the context of the high-yield municipal bond market. And we are talking about this product today because in the municipal market, we have seen, and continue to see an opportunity to shorten duration with surprisingly little give up in yield versus a longer duration option. In fact, we have a longer duration high-yield product at Market Vectors. In addition to that, we also believe that, generally speaking, the municipal market, high-yield investment grade, both tax equivalent yields are at compelling levels at this time. A couple of other more comments on this product, SHYD, the Short High Yield Municipal Index ETF. The three bullets below, I want to point out the 25% triple B investment grade exposure. We do that in both our high yield ETFs. It is a liquidity enhancer, makes the product a little bit more crossover than pure high yield, but I think it's an important element to highlight here. We've talked about what bond duration is, and as I said, duration is basically a measure of the sensitivity of the price of your bonds to movements in interest rates. Without getting into the bond math now, and I'm sure most people on this call know it better than I do, we do want to show how it played out over the course of a little more than a year in the municipal market in general. We are looking at short-term high-yield munis, which is the green line on this chart, and the all-maturity high-yield index, which is the dotted line on this chart. You can see a significant difference in total return over the period from December 2012 to March 2014, basically driven by movements in interest rates. And you see the difference in return gap the widest during that period early last summer and toward late summer when interest rates moved the greatest. More specifically, to another note I made about municipals, which was the surprisingly little yield give up for moving down the yield curve. Approximately 100 basis, or just over, I think the measure here was about 101 basis points. The yield of the two indexes, or any index shown on this chart, is the left-hand scale, and the duration, less risk and more risk on that arrow, are referring to interest rate risk, mind you. Duration being, on the lower axis, on the x-axis, and yield on the y-axis. The all maturity high yield muni index has a duration of 9. Back of the envelope, ignoring some other measures such as convexity, a 1% move in interest rates means approximately a 9% loss in price on something with a duration of 9. Short-term high-yield muni index has a 3.4 duration, so call it a 3.5% loss versus a 9% loss for a 1% move in yields. Also, I do want to point out, you see the green square for these short-term high-yield muni indexes right next to a high-yield corporate index. And you can see on an absolute basis, the yields are virtually the same, and durations are quite similar. But I will also remind you that this chart is showing actual yields, not pre-tax yields. Not after-tax yields. So we will go to the next page and highlight, depending upon your tax bracket, if you looked at a comparable yield on an after-tax basis for investing in high-yield municipal bonds, you would be looking at a significant pickup versus U.S. high-yield corporates. This is the Barclays High Yield Index, for your information that on the corporate side that we're looking at. So this is what we meant by a compelling story for muni yields on an after-tax basis. We also think there's quite a compelling story for the little give up in yields from moving down the curve and taking away some of the interest rate risk.
Fran, chiming in here really quickly. If you look at the general muni market, it tends to be rather long in duration, right? So your short duration product is sort of quite noteworthy in that regard, is it not?
Yes, correct. Municipal bonds is a long duration product in the base case. And generally speaking, when you go from investment grade to high yield, you are losing some level of interest rate sensitivity anyway. Higher spreads tend to provide a cushion, at least against smaller moves in rates. And you've seen in the corporate market at times, again, as we showed earlier, there can be quite negative correlations between treasuries and yields. But as everything is compressed here, we believe even high yield markets in municipals and in corporates are going to be a little more sensitive to the absolute level of rates. But yeah, muni indexes are generally quite long duration. We remind you that municipal bonds are often called at around a 10-year to maturity, so that duration number can be a little bit misleading versus what's realized, but you still, by focusing on shorter maturities, are reducing that duration, importantly.
And Fran, this is Pratik. If I can add there, this is a very interesting product because I would hazard a guess it's the only one of its kind that's been launched. I mean, there's been shorter duration versions of some of the other fixed income segments, but I think I haven't seen a short-term high-yield muni ETF yet. So kudos to market directors for coming out with a very innovative product. And Fran, if I can just ask, and I don't know the answer, what's the historical default rate on high-yield munis versus just regular munis?
Yeah, well, I mean, the default rate overall is far lower, by the way, than in the corporate market. So it's less than 1% historically. If you look at the high-yield U.S. corporate bond market, you're talking about a 4.5% historical default rate. The municipal market, I'm trying to just see how far back we go, but we have a 0.94%, and I believe we're talking almost 40-year history on that, 38-year history.
And in the wake of the subprime mortgage crisis, has the default rate been above that historical average significantly, or not so different?
Sorry, not significantly. Clearly, you've had some changes in the municipal market, and insurance is becoming a smaller, I guess, sort of enhancer. And you have certainly some high-profile situations such as Detroit, which are going to cause an uptick. But still, even the U.S. Corporate default rate, which is still running below 2%, is actually still above the muni rate.
Okay. Thank you.
Thanks, guys. And that's a good question. I mean, these are high yield for a reason. There is risk of default. We have a second approach I mentioned to reducing duration in your portfolio. Is doing so not by moving down the yield curve, but by directly hedging with treasuries, going at the culprit, if we'll call it. And we again designed a product focused on the high yield market, but this time the taxable corporate high yield market. So a portfolio of high yield corporate bonds, U.S. issuers, is the long side of the portfolio in THHY, the Market Vectors Treasury Hedged High Yield ETF. The portfolio is short an equivalent amount of 5-year U.S. Treasuries, actually by proxy through Treasury note futures. So THHY it tracks an index that is long high yield, short 5-year treasuries. It still offers income. The negative carry associated with shorting 5-year treasuries is obviously more than covered by the positive carry of owning a portfolio of high yield bonds. I want to just highlight another risk point here, but the third bullet point, in a quote-unquote risk-off environment, which I described earlier without labeling it as such, when U.S. Treasuries rally and the prices of high-yield bonds decline, think 2008, THH, that's an environment where a strategy like THHY would do worse than an unhedged Treasury strategy and could experience significant losses. As I mentioned, THHY is mitigating the negative effect of rising interest rates. You have credit spread exposure. You have all the credit exposure that you would in a high-yield index. What THHY is really trying to get at is either hedging away or even benefiting from the negative impact of rising rates by selling the futures on 5-year treasuries. I mentioned during the last slide about the pickup in yield, and you could look at current yields here over time, not just in today's environment, but still at 5.33% on a high-yield portfolio today, which is admittedly considerably lower than 2010. There is still significant income potential from a product like THHY. Wanted to highlight, again, sort of what happened last year. In fairness, this chart does not show the 2008 environment, but I did allude to that earlier, where things moved in opposite directions. In the Treasury sell-off, the taper talk Treasury sell-off last summer, you saw a hedged portfolio of high-yield bonds, or an index representing a Treasury hedged portfolio of high-yield bonds outperform an index of unhedged high-yield bonds. Over the course of this entire chart from the beginning of last year, the pre-taper talk till roughly today, you've seen that these two types of strategies would perform roughly on an equal basis. I will point out that during that June period, where the hedged approach outperformed the unhedged approach, spreads actually did widen during that period, but between current yield and gains on treasuries, it did not take long for the Treasury hedged approach to recover a small downtick. There are other ways to get high yield or sub-investment grade exposure with limited duration, and this is not a product in our offering, but it is a popular product today, so wanted to address that. Bank loans, or otherwise known as leverage loans, the sub-investment grade bank loan market has become a very popular approach. We did want to show on this page that the Treasury hedged approach, again, over this latest incarnation of higher rates from early last year till through March of 2014, has actually performed better than some of the bank loan indexes. And that is partly because of the direct benefit from being short the Treasuries, actually gaining from the movement in rates. The other sort of I wouldn't call this a highlight, but a couple of things to point out on the high yield bond market versus the leveraged loan market. Leveraged loan market has some attractive characteristics. Downside protection. Bank loans are secured. They're higher up in the capital structure than high yield bonds. In higher default environments, recoveries on bank loans that have gone into default will generally be significantly higher than on high yield bonds. On the other hand, bank loans are less liquid. We've seen tremendous inflows into bank loan ETFs in the last year, but certainly the bank loan mutual funds have existed for some time. In 2008, despite the in early 2009 perspective of higher recoveries, bank loans actually underperformed high-yield bonds for some time because of the liquidity conditions in that market when there was forced selling. One other point is often bank loans are certainly, there's prepayment callability. High-yield bonds are often callable. They just tend to have better call protection. So when the bank loan market trades near or starts getting above par, it's a potential for price appreciation tends to be more constrained than it is for high-yield bonds in a credit-favorable environment. With that, if there are no comments or questions from Olly or Pratik, I'll move to our third approach, which is another floating rate approach. We just talked about bank loans. I want to talk about a different type of floating rate instrument, which are investment-grade floating rate notes, or FRNs. So this is a much more conservative approach than bank loans in that, but also with considerably lower yield. But much like bank loans, floating rate notes have a coupon reset feature. The coupon on a typical FRN represents the LIBOR rate, 3-month LIBOR, plus a credit spread compensation for the credit risk of the issuer. That coupon resets quarterly as LIBOR moves. So what you get in a floating rate note, much like a bank loan, is potential to start earning more income from your investment as short-term interest rates rise. In FRNs, as opposed to bank loans, you're getting investment-grade quality. And again, this is another product that's near zero interest rate duration. A little bit more on just how on FRNs and how they work. The chart on the right here is the green part of the bar represents 3-month LIBOR, which I said is typically your reference rate for a coupon. The gray part of the bar is the spread at which an FRN might be issued. So a well-known bank or a consumer products company might issue a floating rate note, and the market might say, oh, we like this company, we'll buy these at LIBOR plus 25 basis points. So if LIBOR is at 25 basis points or 0.25%, and the spread is 0.25%, your initial coupon is going to be 50 basis points or 0.5%. As LIBOR shifts up, the stated spread over LIBOR stays the same, but your coupon will rise with LIBOR, and similarly it will fall as the LIBOR rate comes down at coupon reset periods.
I wanted to ask you about Fran, when I mentioned in my intro that rates have been heading higher, but sort of a little bit up, a little bit down, a little bit up, kind of a very choppy progression. And on these floating rate notes, when it is in a downward adjusting period, the mechanism is exactly the same, and the rate would fall commensurate with the decline in LIBOR or whatever the benchmark, right?
Correct. Correct. This is meant to be very, very close to zero duration. So if you could imagine if the credit profile or price of credit, the risk premium of the issuer didn't change much over time, an FRN is designed to very much hold its price, at least relative to interest rate movements. And again, just a strong reminder for everyone, if 5-year yields are moving up and down, but LIBOR is staying the same as we've seen in the last year, these coupons are not adjusting very much. When you might read even more about FRNs is when people are talking even more seriously about the Fed beginning to adjust the Fed funds rate and the impacts on the short end of the curve.
So, Fran, if I can ask a question. Now, since these notes are linked to LIBOR, what's the interplay between the federal funds rate and LIBOR? I mean, if the Fed's raising rates, are LIBOR rates historically gone up, or what's the correlation?
Yeah, you're going to see a pretty high correlation because really you're talking about short-term rates of it's just who's lending to whom at what, and the Fed funds rate is really a symbolic target. LIBOR is a much more important rate for the market, but that will react to the Fed's rate. So you'll see a very high correlation over time. I mean, LIBOR is the rate at which banks lend to each other. They are not going to be lending to each other too often at a rate below a Fed funds target or even the discount rate where a bank can go and borrow from the Fed itself.
So from a global monetary, policy perspective, the UK is obviously ahead of us. I mean, in reversing the QE, and maybe they're going to hike rates before we do. But the ECB is battling with deflation. So, I mean, which of these global economies would have a more direct influence on the LIBOR getting reset higher?
Although it's the U.S. economy, right? So there's a London Interbank offered rate, but this is basically a dollar rate, and it's going to be affected by U.S. Monetary policy. It's going to be affected by U.S. Financial conditions. Other factors can impact LIBOR, including perceptions of banks' own credit risk. So LIBOR could actually move higher at a faster rate if there's concerns about bank balance sheets, for instance. So it's more now there's an interplay, of course, where if Europe continues to battle deflation, that has negative ramifications for U.S. growth, and you may not see the reaction in our rate markets as quickly as if Europe were growing and having a positive impact on U.S. growth as well.
Well, thank you.
I want to highlight that although floating rate notes are investment grade, so an implied lower level of credit risk than, say, bank loans or high yield bonds, there is credit risk that's spread over LIBOR that these borrowers pay, and we wanted to highlight showing about almost a 10-year history of the Barclays U.S. dollar FRN index alongside the U.S. corporate bond index, which is an investment-grade bond index. During the financial crisis, FRNs did experience capital loss, capital depreciation, and during that period, they did outperform during the worst part of the crisis, the corporate bond market in general, but still a fairly significant drop. And again, investors should be cognizant of you're still assuming credit risk, although again, these are investment grade credits spanning triple B to triple A. One reason for this outperformance, by the way, during the 2009 period, FRNs have zero interest rate duration. There's a different type of duration that we talk about, which is credit spread duration. So if your spread moves from 25 basis points over LIBOR to 75 basis points over LIBOR, your price is going to adjust. You still have that sensitivity in price to movement in your spread over the reference rate. But FRNs are generally issued at 5 years and in, so their spread duration, their sensitivity to spread movements tends to be lower than the corporate market in general, which leads me to another point about our FLTR product and the index. We track the market vectors FRN index. We actually, the index is not completely market capitalization weighted. It's designed to overweight longer maturities, mainly between 2 and 5 years, versus maturities between 0 to 2 years. This has the effect of adding a little bit of spread duration, credit spread duration, to to the portfolio. The trade-off is you tend to get paid a higher yield. This is a very low-yielding asset class in this environment with LIBOR so low to begin with. But that's a difference between the index we track and some of the indexes out there, between our product and some of the other products out there. Higher yield, same issuers, just longer maturities, and you get paid a little bit higher spread for that. And I have spent a lot of time on these three products, so I thank you all for listening. And Olly, should we move to Q&A, or do you or Pratik have a few more comments?
Pratik, if you have anything to ask Fran or anything to say, go right ahead. We certainly have gotten some questions in from the audience, which is great, and I've got a few of my own. But Pratik, please, if you've got anything, step right in.
Sure. What I would want to add, and maybe we could do it at the end, but a takeaway for all the participants today, from my point of view, would be, we are obviously trying to balance a trade-off here between interest rate risk and credit risk. And as Fran said, we are in an environment where it's a benign credit, credit environment. So you want to be overweight credit versus duration. So we are straddling these two risk parameters. Now, when we build these portfolios using ETFs as an asset allocator, one of the metrics that I use is what's my return per unit of risk, and kind of similar to what the way we look at the equity world. Well, what kind of return has this investment generated for the risk we took? And the risk could be the annualized volatility. So return per unit of risk. So think of the yield to maturity as the return you're getting on your bond or bond ETF, and think of the duration as the risk or the volatility substitute from the equity market. And then from our point of view, we are trying to maximize that without going too far out on the credit risk spectrum. So yield to maturity divided by the duration, and that ratio we're trying to maximize.
Okay, thanks, Pratik. The audience questions are very much focused on risk, both credit and duration, so that's certainly an appropriate comment, Pratik. Little housekeeping, Fran. Expense ratios on these funds, that's a pretty straight-ahead question, but allow me to blow it out just a little bit in terms of complexity to talk about the broader costs of these funds. How do they trade? How's their liquidity? Bid-ask spreads, things like this. What's the best way to trade these in order to control costs? Because certainly the cost of owning an ETF is more than just the expense ratio. So let's start with the expense ratios. The SHYD, the short duration high yield municipal ETF. What's the expense ratio on that?
0.35%, 35 basis points.
35 bips, so $35 for every 10 grand. Okay, and then let's move to the next one. Market Vectors Treasury Hedged High Yield Bond ETF, the one with the duration overlay, THHY.
Right. There's a quoted, by the way, expense ratio there of 80 basis points. That is by regulation includes basically the cost of the hedge in the portfolio must be stated as part of the expense ratio. But that 30 basis points of that 80 is actually being absorbed by the returns, within the returns of the fund. So the actual cost in fees after returns is 50 basis points.
Okay, and the cost of hedging varies according to how yields are moving, or did I misunderstand you?
No, it can vary.
Okay.
Because we're using futures, it tends to be more of a fixed cost. With physical, if you invest in something with physical shorts, it might be a much more variation. Actually. Okay,
and then let's move to the third of the ETFs, the FLTR, the Market Vectors Investment Grade Floating Rate ETF.
Sure, quick answer this time, 19 basis points.
Okay, straight ahead. Yeah, I figured the hedged one was going to get a little complex. So let's talk about other costs, tradability and stuff like that. How are these things trading, and how can advisors and investors sort of maximize their chances in the traffic of executing effectively and with an eye on minimizing costs?
Right. Generally speaking, the best way to minimize costs is to, one, keep an eye out. First of all, a lot of ETFs, particularly fixed income ETFs and ones that go into the credit space, may trade at premiums or discounts from time to time, and you want to know where you're buying relative to net asset value. To give you examples, today, SHYD has been trading with about a four penny bid-ask spread on a dollar price near 25. So that would imply, more like 16 basis points in price. Similar historically for FLTR, which as it has grown, it was a smaller fund until about the middle of last year, has become, more competitive. The THHY, still a relatively small fund, trades typically a little wider bid-ask than the other two. Couple of important factors also are simply, understanding to the degree the advisors have relationships with certain market makers. Some are better and more aggressive, I'm not going to say who or when, but at pricing fixed income products. Some are aggressive because they are constantly building positions. They're using the creation and redemption process to manage their liquidity and improve their pricing. And so just knowledge of the market makers. We have a capital markets group here at Van Eck who are very, in tune with the marketplace. They monitor those market makers and would be happy to direct people if they have questions.
Yeah, they can help someone work a trade carefully. It's kind of what you're suggesting there. Yeah. Okay. Good. There have been some, as I said a moment ago, questions about risk. Let's talk about SHYD, the short duration muni product again. Any Puerto Rico bonds in that portfolio?
Yes, there are. The portfolio now is about 5.98% Puerto Rico, and I will highlight that two things. One, that the index that SHYD is tracking did a reconstitution at the end of March, basically capping territorial Puerto Rico exposure in the index to 8%. So Puerto Rico will be constrained to below 8% in that index going forward. It was unconstrained prior to that. The largest state, by the way, in SHYD is California at about 8%.
Right. So Puerto Rico just shy of 6, and it's going to be capped at 8. Is that the essence of what you just said?
Yes, correct. Thank you.
Okay, great. And another one on SHYD. Can you comment on the default risk of SHYD relative to high-yield corporates of similar duration? So if there is indeed a tax benefit in owning munis, what's the guidance on short-duration muni bond defaults relative to the corporate high-yield space?
Right. Again, past results are no indication of future performance. We addressed this a little bit earlier. The muni space is seeing defaults. It has seen few over time, but the default rate has been considerably lower. As I said, historically in high-yield munis at around 1% versus about 4.5% for corporate bonds. That can change in the future. There are, obviously, again, we mentioned Detroit may, you'll see that statistic uptick a little bit this year for high-yield munis, but the historical picture has been pretty good relative to the corporate market, or very good. Because of that, the only caveat I'll say is there's less history of sort of recoveries and assessing recovery rates in the muni market versus the high yield corporate market. But even in the high yield corporate market, there may be an average recovery rate over time that's well documented, but there's a wide dispersion around that. So still difficult to compare.
Pratik, I want to put you in the hot seat as a practitioner really quick. In your early slides, Pratik, you talked about how you conceptualize asset allocation, and you had those three circles and the intersections between them. You didn't really speak to the market vectors products that Fran spoke about subsequently, but I'm wondering if you might revisit that with a more explicit view on these products. How would you integrate them into an overall thoughtful asset allocation approach in the face of a yield outlook that seems to be, well, gingerly heading higher if in fits and starts, as I suggested at the outset?
Absolutely. So if we go back to the core satellite graph that we looked at earlier, in the core traditionally or currently is the Barclays Ag Index. And if you look at the Barclays Ag Index, the way it breaks down is 36% held in U.S. Treasuries, about 30% in mortgage-backed securities, about 6% in agencies, and about 23% in corporate, and the balance in rest of the assets. Now, as I said, when you're at the cusp of a secular bear market in an asset class, you have to be very careful how much you've allocated to the core, and that's where satellites, the three satellites that Fran presented today, came into play. He alluded to senior bank loans, short-term, high-yield corporates is one area, and another very important area that we use quite extensively within our portfolios is emerging market debt. And when we look at emerging market debt, it's quite a large space, probably close to a trillion and a half. Most advisors tend to think of sovereigns when we talk about emerging markets. Well, sovereigns is just part of that. You could go into corporates, you could go into high-yield corporates, and you could get into local emerging market currency debt. And the locally priced debt generally has a higher yield and a lower duration. So then you're trying to balance out the yield versus duration, and you're trying to add lower correlated assets. And when if your overlying macro theme is that you're at the cusp of a secular bear market in bonds, you want to have very little in the core, and as little as going from 100% to maybe 20 to 30%. And then you want to shorten the duration as much as you can in the core, and then you add more satellites that we just talked about, while optimizing your duration versus the yield. So in our global fixed income model, we're trying to diversify that where our duration is less than 3, it's probably closer to 2.5, and we are still able to get about a 5% yield on that. So Olly, I don't know if that answers your question, or if you want me to get a little bit more granular.
I think that's a good start. Unfortunately, we have run out of time and left a few questions on the table, unfortunately, but it's been a good discussion. So that does conclude our webinar today. Don't be so sensitive. Multiple solutions to mitigate interest rate risk. Fran of Market Vectors and Pratik of Endowment Wealth Management, thank you very much for being my guests, and I want to thank the audience for attending and also for asking some illuminating questions. And again, I want to remind you that the deck will be available to all of you in 24 to 48 hours. On that note, on behalf of all my guests and all my colleagues here at ETF.com, I'm Olly Ludwig, wishing you all a pleasant afternoon.
Thank you.